Okay, in this question here, we're looking to find out uh, some information about the business by doing an analysis of some of the numbers. So when you've got a trading profit and loss question, there's only two pieces of information you found out by doing a trading profit and loss in your balance sheet. So your trading profit and loss, at the end of it, you found out your profit. It's a number. It doesn't mean whether the profit is a good profit or a bad profit. It's just this is €35,245. This is how much money we've made after a year's work. Your balance sheet, on the other hand, shows what the business is worth. So the net assets, so this is the fixed assets. These are long-term things we have that will last many years. Some short-term things minus some of the bills, the short-term debts we have, giving us working capital, which is money we have to play around with. So this working capital here is a minus, so we have lots of debts here. And you do have lots of assets there. So our business is worth 173,000. So if somebody wanted to buy it, that's the amount of money they need to spend to buy the business. And the finance buy is how we paid for setting up the business. So it's worth 173, and this is where the money came from. So it came from capital, some of our profits we saved, and we got a loan as well. Okay, so that's all we found out about the business. Now we need to try and do some more analysis. So I want to find out this profit here, is it good profit? So we're looking at profitability. Now there are two people invested money in the business, two groups of people. They are shareholders, they put in capital, and they allowed the business to keep the profit, because the profit that the business makes, ultimately, this 35,000 is belonging to the shareholders. It's not belonging to the business. And the shareholders have taken out 31,500 in dividends and allowed the business to keep 3,745. Also, as well as shareholders, we have money that's been invested by banks. So we got a van loan, we could have a mortgage, any money that was invested by a bank, that was also put into the business. So when we're looking at profitability, there are two formulas. We look at return on capital employed. So return on capital employed is the money made from all the money invested by all of both of the groups who are investors in business, the shareholders and the banks. So in this case, capital employed is 173,730, and our net profit is 35,245. So we have 35,245. So there's our profit, and we're going to divide that number by the total of capital employed, and we're going to turn that into a percentage. So times 100 over 1. So I get an answer of that. Let's see, divided by that, and times 100. So that's, and that answer is a percentage. Okay, so I'm just going to put a percentage sign there beside it. Now, what does that mean about the business? That means if we had put our 173,000, the money invested in the business, if we didn't invest in the business, if we just put it into a bank account instead, we would have probably got an interest rate of maybe 2-3%. Instead, we've put it into this business and we've earned 20%. So this is a profitable business. We're making good profit. Now, if we look at return on owner's equity or return on shareholders' funds, it means the same thing, okay? That's looking at the money that is earned, okay, in the business, and it's comparing that only to the money invested by shareholders. Now, normally, the money you would take into account the net profit, and we would also take away our interest, so the profit after the interest has been made. We don't have interest listed here, so we're going to just use our net profit figure. So we have the same 35,245, and we're going to divide that by the money invested by the shareholders only. So that's going to be, well, we can see there's 160,000 of ordinary shares plus our retained profit from this year. Remember, that money is owned by the shareholders and they've allowed that to stay in the business. So we're going to turn that into percentage. So I multiply that again by 100 over 1. So that divided by that, and then multiply the answer by 100. So we get a figure of 21%. And again, the shareholders would be very happy because they could have put their 163,000 into a bank and they would have got maybe 2 or 3%, but instead they put into the business and they got 21%. So this is a very profitable business. Like I say, the only thing I would say with this formula, usually if you look at the formula in the book, it would say net profit, and it would be the net profit it would be operating profit minus interest. So it's the real net profit figure, where this one here will be the operating profit that we're talking about. Now, operating profit, just so we know, is net profit, and we add back in the interest. That's the difference that we would have in these two formulas. So this formula here is after the interest has been taken away. So now we move on to liquidity. Again, we're looking at judging the business. So liquidity is basically our ability to pay debts. When we look at profitability and you're doing an analysis here, you would basically say, are we making enough profit from money invested? Okay. And sorry, I'm just going to put a question mark in the end, because that's what we're asking ourselves. Are we making enough profit from money invested? Liquidity basically is all about, can we pay our debts? So our answer for liquidity would be, our liquidity shows this company has a good ability to pay debts or a bad ability to pay debts. So we look at the working capital ratio. And the working capital ratio compares current assets to current liabilities. So current assets in this case is 21,615, and we compare that to the current liabilities, which is 41,745. Now, if I can give an explanation for your family, the current assets for your family would be, let's say, stock. So that could be the food that you've got in your fridge. It could be the cash that your parents have in bank accounts, and maybe money that might be owed to you. So your family has this lump of money available to pay whatever debts they have. So the current liabilities, so they may have credit card bills, they may have an overdraft, they may have electricity bills. Those are the normal bills. So the question here is, are those bills a major burden for the family when we compare it with the amount of cash we have available to pay the bills? Now you can see here the bills are 41,000 and we have cash of 20,000. So we don't have anything like the amount of cash. So to make it comfortable, what we would normally be looking for, so to show that the business is comfortably able to pay their debts, we're looking for an answer of 2 to 1. That means we should have at least twice as many current assets as current liabilities. Now in this case, the answer is 20,000 divided by 41, so you get 0.49 to 1. Okay, so that is really poor. Okay, sorry, I'm just going to put this down 1 second. Sorry, I've made a change, mistake in my formula there. So the okay, no, that's still coming up again. So we're comparing. Sorry, an answer of 0.49 or about 0.5 compared to 1. So that means that this family has a real issue paying their debts. Oh, that won't let me put 1 in. Okay, you understand the idea behind it. Anyway, so now we look at our asset test ratio. So this is like the emergency ratio. So if all of our current liabilities sued us and demanded all of our money back, we must have at least enough money to cover those debts. So we're looking for an answer here of 1 to 1, a minimum of 1 to 1. So the asset test, the only difference, if we look at our current assets and current liabilities, the only thing with an asset test, it doesn't include closing stock. Because if we were getting sued, if the bank sued us and our creditors sued us or threatened to sue us to get the cash to pay our bills, well, we already have 570 in cash. That's available to pay our bills. Our debtors, they owe us 14.3. Now, if we turned around and offered them, let's say, a 5% discount, we would get most of that money quite quickly if we offer them a discount. The stock, though, the goods sitting on our shelves, it can take quite a while to turn that into cash. So that's why we ignore it with the asset test ratio. So the asset test ratio in this case is 14,300 current assets plus 570. That gives us our current assets without our stock, and we compare that to our bills of 41. So, and again, the answer should be something to 1, and we get 0.35. So that means we've only got about a third of the cash we need to cover our debts. So this business, getting back up to what we're looking at, can we pay our debts? This business has a major problem paying our debts. So I would be worried. Despite the fact we're making good profit, we have a major problem paying our debts, which is a worry. Why is this happening? I think in this case, rather than taking the 200,000 that we're earning in sales and using that to make sure all of our bills are paid, I think we're using a lot of that to buy things like machines, and we're not keeping enough cash spare to cover our debts. That's one of the problems you see here.